Hello everyone, welcome back to the channel. If you are completely new to trading and don't know what the stock market is, what these candlesticks mean, and why traders always talk about support and resistance, then this video is for you. In this video, you will learn what the financial market is, different types of financial markets, what candlesticks are and why traders use them, the anatomy of and psychology of candlestick, the strength of different candlesticks, support and resistance, and one engulfing pattern. By the end of this video, you will have a strong foundation to start understanding charts like a trader. So let's get started. What is the financial market? A financial market is simply a place where buyers and sellers exchange financial assets. Think of it like a marketplace. People generally buy and sell groceries or clothes, etc. But in financial market, people buy and sell assets like company shares, currencies, commodities, and cryptocurrencies. The price keeps changing because of one simple rule: supply and demand. When more people want to buy, prices usually more higher. When more people want to sell, prices usually move lower. Every momentum on the chart is simply the result of buyers and sellers competing with each other. Types of financial markets. So there are many financial markets, but beginners should know these four: stock market, forex market, crypto market, commodities. Stock market means people buy and sell shares of companies like Reliance, TCS, Infosys, etc. Where forex market is, forex stands for foreign exchange. Here traders buy one currency while selling another. Example Euro USD, GBP USD, USD JPY. It is the largest financial market in the world. Cryptocurrency market. Market is used for trading digital currencies, Bitcoin, Ethereum, etc. Unlike stock market, crypto market operates 24 by 7. Commodities. Commodities nothing but natural resources like gold, silver, crude oil, natural gas. Commodity prices move because of changes in supply and demand, weather conditions, and global events also. Now, what is candlestick? What is candlestick? Before we learn about candlestick, let's first understand the line chart. A line chart is the simplest type of price chart. It connects only the closing price of an asset using a line. You can see only closing prices. This gives us a quick overview of whether the price is moving up or down or sideways. For example, if today's closing price if today's closing price is higher than yesterday's closing price, the line moves upward. If today's closing price is lower than, the line moves downwards because it only connects the closing prices. A line chart is simple and easy to read. However, it does not tell us the complete story of what happened during that time. It does not show how high the price went, how low it went, or who was stronger, buyers or sellers. That's why professional traders use candlestick charts. Candlestick charts. We got now what is candlestick? What is candlestick? A candlestick shows what happened to the price during a specific period of time. For example, One candle can represent 1 minute, 5 minute, 15 minute, 1 day, etc. Many beginners ask, why do traders use candlesticks instead of line? The answer is simple. A line chart only shows the closing price. A candlestick shows four important prices: open price, closing price, high price, and lowest price. That's why professional traders prefer candlestick charts. Green candle represents buyers, whereas red candle represents sellers. Each candle tells the complete story of buyers and sellers during the time period. Now, anatomy of this candlestick. Body. So it got a body. The distance between open and close price is a body. Wicks. If you see, you can see two lines, upper and above. The thin lines above and below are wicks. Sometimes we used to call it as shadows. So the upper wick shows the highest price reached. The lower wick shows the lowest price reached during the time period. These wicks tell us where buyers and sellers were rejected. Sellers were rejected. Now, understanding the story and strength of each candle. Green candle belongs to buyers, red candle belongs to sellers or bearish. Now, we'll talk about this bullish candle. A large bullish candle. A large bullish candle with small wicks, upper and lower are very small wicks. In this candle, buyers dominated this entire session. They kept pushing the price higher while sellers couldn't stop them. The large body, the stronger the buying pressure. This represents strong buyers' strength. Now coming to this medium bullish candle. Medium bullish candle. Buyers are still in control. Buyers are still in control. Candle opened at this level and went up to this level. From here, a significant amount of sellers absorbed buyers' pressure. Even though buyers won this battle, but not as aggressively as before. This represents moderate buyer strength. Moderate buyer strength, that means sellers are slowly entering into the market. Now, small body. Small body, the body is very small compared to these two candles. Neither side has complete control. The market is waiting for fresh momentum. Means you can see equal buyer's pressure and seller's pressure. We call it as spinning top also. Spinning top generally represents a reversal. Reversal might happen soon. Dozy candle. The opening and closing price are almost same. Buyers tried to move the price higher, sellers pushed it lower. Finally, neither side won. This candle represents complete indecision. It tells traders to wait for confirmation before making any trading decision. Any trading decision. In the same way, here sellers are in control. Here sellers are in control. In the second candle, sellers are losing their momentum. This is spinning top. Soon a reversal might happen. This is doji. So far, you have learned how to read the strength of a candlestick by looking at its body and wicks. Every candle tells us a story about the battle between buyers and sellers. But remember, a single candle alone is never enough to make a trading decision. In the upcoming videos, we will learn how to combine candlestick strength with market structure, trend direction, and other confirmations to identify higher probability trading opportunities. Now, next, support and resistance. Support and resistance are among the most important concepts in technical analysis. Imagine dropping a rubber ball onto the floor, it bounces back upward. The floor acts like support. Support is an area where buyers usually become active and try to stop the price from falling further. Now imagine throwing ball towards the ceiling. It hits the ceiling and falls back down. The ceiling acts like resistance. Resistance is an area where sellers usually become active and try to stop the price from moving higher. Remember, support and resistance are not just lines. These are areas. We call it as areas or zones. Price often reacts around these zones. Now here, if you look at this here, from this level, price fallen to this level. After reaching to this support level, we will wait for confirmation. We will wait for confirmation whether the market is going to reverse or not. After getting confirmation, the market went up. The market went up. Always wait for the confirmation. So this is the major resistance level. This is major support level. In middle, we will be having minor support and levels. Now in future videos, we will learn how to identify strong and weak support and resistance, how to recognize genuine breakouts and false breakouts, how to use volume confirmation, how to understand whether buyers or sellers are truly in control. These concepts will help you make better trading decisions. Because here, if you see, this is a minor resistance level. Here, minor resistance level, and it got broken by with this candle. Whether this breakout is true or false, we need to identify with the market direction, market structure, along with the volume. Considering this, we will analyze the breakout is real or fake. Now, candlestick patterns. Today, I am discussing two candlestick patterns. One is bullish engulfing pattern, another one is bearish engulfing pattern. So, what are these patterns? I am taking bullish engulfing pattern and bearish engulfing pattern for an example. There are many patterns like morning star pattern, shooting star, outside bar, inside bar, hammer candle. There are many kinds of patterns. But in today's video, I am only discussing bullish engulfing or bearish engulfing. Now imagine sellers were controlling the market. Sellers were controlling the market. After reaching to this support level, suddenly buyers entered with strong momentum. Buyers entered with strong momentum. This new bullish candle completely covers the previous bearish candle. This shows buyers have taken control. Buyers have taken control. In the same way, bearish engulfing pattern. Suppose buyers were in controlling the market, means market moving upward. After reaching to a level, after reaching to a level, bearish candle completely covers the previous bullish candle. This shows sellers have taken control. Sellers have taken control. Always remember the pattern itself is not enough. An engulfing pattern that forms randomly in the middle of the chart may not be very meaningful, but when it appears near important support and resistance levels, along with proper confirmation, it becomes much more reliable. In future lessons, we will explore many more candlestick patterns and, more importantly, learn where and when to use them effectively. When to use effectively. Now, we have learned about what is financial market, different types of financial market, what candlesticks are and why traders use them, the anatomy and psychology of candlesticks, how to understand the strength behind different candlesticks, support and resistance, and engulfing pattern. These concepts are the foundation of technical analysis. Technical analysis. Now, becoming a successful trader isn't about memorizing the patterns or indicators. Most beginners fail because they trade based on single signal, enter trades without confirmation, ignore the overall market context, or let emotions control their decisions. Now, successful traders, they stay patient, understand the market structure, wait for confirmation, manage their risk, and make the decision based on multiple factors, not just one candle or one indicator. So, if you found this video helpful, please like, share, and subscribe so you don't miss the upcoming lessons. Thank you for watching. I'll see you in the next video.